It never begins with collapse. It begins with comfort. The currency still works, the markets still hum, and people still trust numbers printed on paper. But somewhere beneath the surface, a quiet fracture appears. Rome felt it when their silver coins grew lighter. France felt it when their assignats bought less with each passing week. Weimar Germany felt it when wages rose daily, but bread rose hourly. And every nation believed the same comforting lie, that their money was different. It never is. Currencies don't fall in a single moment. They rot in stages, slowly at first, then all at once, until the illusion shatters and the paper meant to preserve value becomes proof that value is gone. Yet history shows another pattern too. In every collapse, a small group saw the shift early. Not because they predicted the future, but because they recognized the steps every empire takes right before the fall. And today, those steps are visible again. Picture this. A German housewife in November 1923 walks into a Berlin bakery clutching a wicker basket overflowing with paper money. Not bills tucked neatly in a purse, but pounds of currency stacked like kindling. She counts out 4 billion marks for a single loaf of bread. 4 billion. The shopkeeper barely glances at the mountain of paper before sweeping it into a bin already overflowing with worthless notes. Outside, children play with bundles of money like building blocks, constructing castles from what was once the foundation of an empire's economy. This wasn't fiction. This was Tuesday afternoon in Weimar Germany. What you just witnessed wasn't the beginning of currency collapse. It was the end. The final, spectacular implosion of a monetary system that had been dying for years while most people believed it was perfectly healthy. Because here's what history teaches us about money. Currencies don't just vanish overnight like magic tricks. They follow a pattern, a deadly, predictable sequence that has repeated across empires, continents, and centuries with mechanical precision. Every great currency collapse follows 7 distinct stages. 7 steps that transform sound money into worthless paper. 7 phases that have toppled empires from Rome to France, from Austria-Hungary to Argentina. And if you understand these stages, you can see something unsettling about our current moment. The United States dollar, the world's reserve currency, the bedrock of global finance, has already passed through the first 4 stages. It's deep into stage 5 right now. And most Americans have no idea. This is empire economics, where history and money collide. And nothing is ever as stable as it appears. The 7 stages of currency collapse weren't invented by economists in ivory towers. They were discovered by watching real societies rise and fall, by studying the bones of dead empires and the ashes of forgotten fortunes. Stage 1 begins with sound money. Real value backing real currency, gold, silver, something tangible that can't be created from thin air. This is where every great monetary system starts. Confidence built on substance, but empires grow ambitious. Stage 2 arrives when governments expand their military reach beyond what their treasuries can afford. The Roman legions marching toward distant frontiers, the British Navy patrolling every ocean, the American military establishing bases on every continent. Military power projects strength, but it devours wealth at an alarming rate. Stage 3 transforms temporary military expansion into permanent warfare. What begins as strategic necessity becomes perpetual conflict. Resources that once built infrastructure now fund endless campaigns. Tax revenues that once supported prosperity now disappear into the machinery of war. The treasury bleeds, but the wars continue. Then comes the moment of truth. Stage 4. The government faces a choice between raising taxes to crushing levels or finding another way to pay the bills. They always choose the other way. Currency debasement, the quiet, invisible tax that steals wealth without voters realizing what's happening. Roman emperors mixed base metals into silver coins. Medieval kings shaved precious metal from currency edges. Modern governments simply print more money. But here's where the pattern becomes dangerous. Stage 5 arrives when people begin to notice the loss of public faith. Prices rise faster than wages savings by less than they did last year. International partners start demanding different currencies for trade. The spell breaks. Confidence, the invisible foundation holding the entire system together, starts to crack. The United States reached stage 1 with the gold standard. For over a century, American currency was backed by actual gold reserves. A dollar represented real value, not just government promises. But in 1971, President Nixon severed that link forever. The dollar became what economists call fiat currency, money backed by nothing except trust in government. Stage 2 arrived with the Cold War military buildup. American forces deployed globally, defending allies and projecting power across continents. The Pentagon's budget grew from millions to billions to hundreds of billions. Military spending became a permanent feature of American fiscal policy, consuming resources that might otherwise have strengthened the domestic economy. Stage 3 manifested as perpetual warfare in the Middle East. Iraq, Afghanistan, Syria, and countless smaller conflicts that drained trillions from the treasury. The war on terror became the war without end, justifying enormous expenditures year after year. Defense contractors prospered while infrastructure crumbled and national debt exploded. Stage 4 began in earnest during the 2008 financial crisis. Faced with economic collapse, the Federal Reserve chose massive monetary expansion over allowing failed institutions to fail. They called it quantitative easing, but it was currency debasement by another name. The money supply expanded from hundreds of billions to trillions virtually overnight. Then came 2020, when pandemic lockdowns triggered even more dramatic monetary expansion. Trillions more created from nothing, distributed through the economy like water through a broken dam. Now we're deep in stage 5, and the signs are everywhere if you know how to look. Foreign nations are reducing their dollar reserves for the first time in decades. China and Russia conduct trade in their own currencies, bypassing dollars entirely. The European Union explores alternatives to dollar-dominated systems. Even traditional American allies quietly diversify their monetary holdings. Domestically, the symptoms are equally clear. Essential goods cost dramatically more than they did 5 years ago. Housing, food, energy, healthcare, education. The things people actually need consume larger portions of their paychecks while wages struggle to keep pace. Meanwhile, financial assets inflate to unprecedented levels, creating wealth for those who own stocks and bonds while penalizing those who rely on salaries and savings. The bifurcation is classic stage 5 behavior. Currency debasement creates two different economic realities. Those holding real assets see their wealth multiply as money flows into anything that isn't currency. Those depending on fixed incomes or cash savings watch their purchasing power erode month by month. The middle class discovers that working harder buys them less, while asset owners grow richer without producing anything. But what happened next in Weimar Germany would change history forever, and the parallels to today are impossible to ignore. When the German government faced impossible reparations payments after World War I, they made the same choice every government makes when cornered. They printed money. At first, the inflation seemed manageable. Prices rose, but wages rose too. Business appeared to boom as cheap currency made German exports competitive. Politicians celebrated the economic recovery. Then, psychology shifted. German citizens realized their money was losing value faster than they could spend it. Shops began changing prices multiple times per day. Workers demanded payment in goods instead of currency. Farmers refused to sell food for paper money that might be worthless by evening. The velocity of money accelerated as everyone tried to exchange currency for anything real before it lost more value. The government faced the same impossible choice that traps every debasing regime. Stop printing money and trigger immediate economic collapse, mass unemployment, and social unrest. Or continue printing and watch the currency die completely. They chose to keep printing, hoping somehow to thread the needle between deflation and hyperinflation. They failed catastrophically. By November 1923, the German mark wasn't just worthless, it was anti-money. Currency so debased that burning it provided more value as fuel than spending it as payment. The psychological breaking point had arrived, and with it came stage 6 of currency collapse. Mass exodus from the failing system. German citizens abandoned their own money en masse. They fled to foreign currencies, gold, silver, anything tangible that couldn't be printed into oblivion. Barter networks emerged as people traded goods directly, bypassing the monetary system entirely. Farmers accepted tools for grain. Doctors took payment in coal, teachers received food instead of salaries. The sophisticated economy of Europe's industrial heartland reverted to medieval exchange systems almost overnight. International markets reacted with brutal efficiency. Foreign investors who had once coveted German bonds now wouldn't accept them as collateral for anything. The London Exchange delisted German securities. Paris bankers refused mark-denominated transactions. New York financiers treated German currency like toxic waste, something to be disposed of rather than traded. Then came the final stage: complete currency collapse. Stage 7 arrived not with fanfare, but with silence. The printing presses stopped not because the government chose wisdom, but because even the paper and ink cost more than the resulting currency could buy. Workers at the mint went on strike because their wages couldn't purchase lunch. The system simply ceased to function. What emerged from the ruins tells us everything about how currencies actually die. It wasn't gradual decline, but sudden, complete replacement. The German government introduced the Rentenmark in November 1923, backed not by gold, but by mortgages on German land. 1 Rentenmark equaled 1 trillion old marks overnight. The old currency became museum pieces, while the new money restored basic economic functions. But the human cost was staggering. An entire generation lost their life savings. Middle-class families who had scrimped and saved for decades found themselves destitute. Pensioners starved while their fixed incomes became worthless numbers on worthless paper. The social fabric tore apart as traditional relationships between work and reward, saving and security, simply vanished. The political consequences proved even more devastating. Democratic institutions lost legitimacy when they couldn't protect citizens from economic catastrophe. Extremist movements gained support by promising simple solutions to complex problems. The very stability that had made Germany a European power evaporated along with its currency. Within a decade, the Weimar Republic was history, replaced by something far darker. Now, look around you in 2025 America and ask yourself what stage we're experiencing. The Federal Reserve's balance sheet has expanded from under $1 trillion to over $7 trillion in less than 2 decades. Government debt has exploded from manageable levels to mathematical impossibility. Annual deficits that once shocked the nation have become routine budget items. Interest payments on existing debt now consume larger portions of federal revenue than entire government departments. International confidence shows the first serious cracks in decades. Foreign central banks have reduced their treasury holdings for the first time since World War II. Major trading partners increasingly settle transactions in their own currencies rather than dollars. Oil producers who once demanded payment exclusively in dollars now accept alternatives. The monopoly is breaking. The 7 stages of currency collapse aren't prophecy. They're pattern recognition. History doesn't repeat, but it rhymes with mechanical precision across centuries and continents. Understanding these stages doesn't create fear. It creates clarity. The ability to see beyond the headlines and political theatre to the deeper currents that shape nations and define generations. Every empire believes its money is different. Every government insists its promises are permanent. Every generation assumes the systems they inherited will last forever, but currencies are not bedrock. They are trust made tangible, confidence given form, and trust, once broken, is nearly impossible to restore. The question isn't whether these patterns will continue. The question is what you do with this knowledge, how you position yourself and your family to thrive regardless of which stage comes next. Because in every collapse, someone survives, someone prospers, someone builds the future from the ruins of what came before. History has given us the roadmap. The rest is up to you. This content is for educational purposes only and does not constitute financial, legal, or investment advice. If you enjoy learning how history and money intertwine, subscribe to Empire Economics for more untold stories.